think we are live. Okay. Yeah. Hey Samfam, how are you all? And welcome to see final audit live discussion, audit questions discussion. Now today we'll discuss company audit, and with first we'll discuss about the wait. Yeah. Now first we'll discuss the RTP. RTP from. Okay. Hey Samsung, welcome to the CA Final Audit Live question discussion. And today we are going to discuss all the questions with regards to company audit chapter. Okay, we'll discuss first the question that was given in the RTP. First, we'll discuss the company's audit question that was given in the November 23 RTP. Though MTP 1 was already released in September, but I couldn't find that in the website, man. If at all anybody find, please DM me that, and so that I could just discuss the questions in the MTPs also. Okay, first we'll see the question under company's audit in RTP, November 23 RTP that was applicable for November 23 examinations. Okay, CAF has been appointed as statutory auditor of XYZ Limited. Okay, wait. F was appointed as an auditor for XYZ Limited for the financial year 20 to 23. XYZ Limited has one subsidiary named AT Private Limited. Okay, it has a subsidiary AT Limited whose statutory auditor is B. Okay. CAB issued a qualification of Coro 2020 for AT Private Limited stating that short-term funds raised were utilized for long-term purposes. You see, under which clause this would come under? That would come under default of loans, right? Yeah, I think that's clause number 9 if I'm not wrong, right? When consolidating the financial statement, CAF. Okay, CAF is the statutory auditor of XYZ Limited, the holding company, decided to include the aforementioned qualification in the audit report of the consolidated financial statement. First of all, let me ask you a question, whether CARO is applicable to CFS? Okay, tell me in the comment section. We'll discuss that later. I'll just tell you in a minute. Okay. The management of XYZ Limited argued that CAF is not obligated to take into account and report the qualification given by CAB, because why they were insisting that CAF cannot report the matters that were qualified by CAB in audit report, because it's a subsidiary company and CARO does not applicable to CFS. Is that so? We'll see. Wait, whether what the management is saying is true or not. Yes, it is true. You see, this is the CARO official notification. Here I have shared this PDF in our Telegram channel. If you want, you could go check that, or else if you have any kind of PDF, that also works, no problem. You see, in CARO official gazette para 2, what they have said. Yeah, this order, this CARO shall not apply to auditor's report on CFS except clause number 21. What is clause number 21? Okay, for CFS this CARO would not be applicable, but what is clause 21? Clause 21 deals about any qualifications or adverse marks by the respective auditors in the reports of the companies included in the CFS. In CFS, what would be included? Subsidiaries, joint ventures, associates, these all entities would be included. Here, in our example, AT Limited is subsidiary. In subsidiary, the subsidiary auditor had qualified that short-term loans were utilized for long-term purposes. That's a qualification. That's a negative remark. Okay, what the CAF has to do, he has to do, if there were any qualifications that were there, for the entities that were included in CFS, this auditor who is auditor of CFS shall indicate the details of the companies. That is, details of the companies is AT Private Limited, it's a subsidiary of XYZ Limited. He have to give the details of that, and the paragraph numbers of Caro report. Caro report paragraph number, that is 9. That is default of loans, right? You see here 9. Yeah, this is clause number 9, under which we have seen here, see, D point, where the funds raised on short-term basis have been utilized for long-term purposes. See, you have to mention the nature of the details of the entity plus the number of the Caro clause that has what, like adverse remarks or negative remarks. Where is this? Yeah. So the management contention is right. Okay. Now we'll see the answer first. You see, the management is saying they should not report, but CAF has to report. What he has to report? He has to report the details of that entity plus the clause number, right? Okay, there's a problem with this. Yeah. So CAF has to report in his Caro report because 21 would be applicable. 21 clause would be applicable. Okay. You see here. Yeah. What they are saying, XYZ Limited is a parent company, that's a holding company, and its subsidiary is AT Private Limited. Facts of the case. CAF is appointed as statutory auditor of parent company XYZ Limited, and CAB has been statutory auditor for that subsidiary company AT Private Limited, and in which there's a qualification was there that short-term funds were utilized for long-term purposes. Under paragraph 2, paragraph 2 is what we have read earlier, that the auditor of CFS the Caro will not be applicable to the audit report on CFS except for clause 21. Okay, they have just repeated the provisions here. And what does 21 says? 21 says that whether there were any qualifications or adverse remarks in the Caro reports for the companies which were included in the CFS, then this auditor shall give details, provide details of the companies and the paragraph numbers of that Caro report. So he has to give details of that company AT Private Limited, and the paragraph number, that's clause number, is clause 9, right? What is CAF's responsibility? Report under clause 21. He has to report under clause 21 and incorporate qualification by CAB. Yeah. And he has to mention the paragraph number that was there, right? That's it. With regards to that management contention is not valid because clause 21 is applicable for a audit report which has doing CFS, right? Okay. In conclusion, the necessary details has to be reported under clause 21 of para 3 of Caro 2020. So that with this we have completed our company audit question in RTP, that is applicable for November 23. Now we'll directly move on to the question bank. Okay, say final question bank. I think I have shared this question bank also in the Telegram channel. If you have any, you use your book. If not, just download the PDF or something and you might take a printout of it. Okay, now we'll see the first question. While adopting the accounts of the year, the board of directors of Sunrise Limited S Limited decided to consider the interim dividend declared at 15% as final dividend. Okay, can they do that? So they consider the interim dividend as final dividend? Yes, they can consider that, because dividend definition is dividend includes interim dividend, so they might do that, no problem in that. And did not consider transfer of that profit to the reserves. Do they really have to transfer the profit to reserves in order to declare a dividend? Not so. You see, in company's audit, from what all the sources could dividend be issued from? It could be issued from C. Out of profits after providing depreciation for that year, out of profits of previous year, and out of balances, that is the reserves that were there, and out of money that was provided by central government or state government. There is no hard and fast rule that the profits has to be transferred to a separate reserve in order to declare a dividend, but they have to provide the depreciation for that. Okay. Yeah. Okay, we have to write the provisions with regards to the dividends first. Under section 123 of Companies Act, the board of directors may declare interim dividend during the financial year out of surplus of the P&L statement. That is what they have talking about, the profit after providing the depreciation. Okay. And after declaring the dividend, what do they have to do? There would be a liability. There arises a liability to pay the dividend. So they have to deposit into a separate bank account within 5 days after declaration of such dividend. They have just given the provisions under the Companies Act. Okay. Here they are saying interim dividend is also a dividend. So after depreciation, after considering depreciation from the profits, they have to declare from the profits the available balance. They could declare the dividend out of there. In the instant case, board has decided to pay interim dividend 15% on paid up share capital, assuming company has complied with depreciation requirements. As they have not given us any facts or any amounts with regards to depreciation, whether the management had provided depreciation or not, we are assuming that depreciation has been 100% duly provided, and interim dividend can be declared even without transferring such percentage of profits to the reserves. It's just an option, it's not compulsory. Okay. And now we'll discuss the second question. Mercedes ALM Limited is into the business of trading of toys. The company was performing well till 2015, and after that sales started showing downward trend. Okay, the company had borrowed working capital funds from a bank on so and so date. The account of borrower was classified as NPA. Okay, the bank appointed forensic auditor to identify if any diversion of funds is there or not. Okay, first identifying the question. See, working capital limits, we'll go with say which gets triggered, like Caro, right? Second clause, inventory more than 5 CR working capital, but there was no quantity of the quantum was not given, so we have to drop from that. And see here, the account was classified as an NPA. Again, willful defaulter, clause number 9, Caro again. Okay, and here they are saying they have appointed forensic auditor. Whether this question is from forensic audit or not, again a question that might arise. Okay, we'll just read the full question and conclude from how to approach this question. Okay, the bank appointed a forensic auditor to identify if any diversion of funds is there or not. Forensic auditor confirmed that diversion of funds. Okay, there were diversion of funds that had happened. Matter went to the court of law and company was asked to recast its financial statement. See, the hero had come here. This is the actual triggering point. Recasting of financial statement for last 5 years. Okay, can court order to recast the financial statements of the company? Yes, court can order to recast the financial statements of the company. Management contended that Companies Act 2013 does not allow to recast for more than 3 preceding years. You see, 3 years is the limit for voluntary revision by the company. Okay, we'll discuss what's the difference between recasting of financial statements and reclassifying the financial statement and voluntary revision of the financial statements in a bit after explanation of this question. Do you agree with the views of the management? Okay, first I will explain you what is recasting of financial statements. Okay, this pen wasn't working right. Okay, recasting of financial statements. What is recasting of financial statement is that there had been an error. You see, business goes and on for several years. You see, in past years, the business had found that in business accounts, they have found that there's a small item. Say like they have missed an invoice, or say like they have missed an invoice of rupees 1000 rupees or 1 lakh rupees, say anything. You see, missing of an invoice is just affects only one balance. So what this, after finding the, say like after finding this error, what might the company do? The company might adjust that into current year, right? They might adjust into current year. Say like, I'll give you another example. The company had taken working capital loan. Okay, you see, the above error, that is for like honesty error, like that's actually an error had happened and the company had genuinely wanted to rectify that error. There's no problem in that. Let me give you another example. Bank had taken a working capital loan, say like for 50 cr. 50 cr is the sanction limit. Okay, after taking 50 cr, for every quarter DP, that is drawing power, has to be calculated. After submitting the stock statements and the data statement to the bank, bank will calculate some drawing power and say like the drawing power is 40 cr for that quarter. Okay, what the company had done, okay, this is how actually it goes on, but they had a fire accident that had happened and stock had been deteriorated and no insurance was there, so suddenly drawing power would be reduced. Now what the company has done, in order to meet the working capital requirement, the company did not account for that quarter in the stock statements that has to be submitted to the bank. Okay, are you getting that? Are you getting my point? Actually here, what the company is doing, company knows that there is no stock due to accident, but the company wanted the working capital drawing power limit for 40 cr. If that stock was accounted, it would be around 10 cr of drawing power, which would not actually suffice for that working capital requirement. So what company has done, company will say, okay, again we could adjust the errors and all, right? So what we'll do is that for this quarter, let not account for that fire accident and let the drawing power would be for calculated for 40 cr. Okay, and is this, and after that quarter, after the drawing power had been submitted by the bank and everything was set, now the company management will come and say, oh, you're so sorry that we had done an error and all. Is that after that quarter, is that a good thing? It is like a violation or cheating the bank, right? With no proper stock statements and all. So this is the reason why the Companies Act did not allow the company to actually recast its financial statement. Okay, recasting financial statement is mostly you done when there was an error in one particular account balance or one particular class of transaction. Okay, this is the reason why the management might misuse this lenience of correcting the misstatements. That's why companies should not recast its financial statements. Financial statements of the company can be recasted only when there's an application that was made by, I don't know what happened to my pen, it's stopped working here. Application made by central government or SEBI, or say like any other like RBI, etc. To whom this application they make to the tribunal or court. Okay, or income tax department also. They make, these government regulatory departments make an application to the tribunal or court. For what? For recasting the financial statement of that particular entity. Okay, only that time they could recast the financial statements. Okay, now what about revision of financial statements? What does actually revision of financial statement is? Revision of financial statements is not that, you see, having so many subsidiaries, say like SBI had like some, I'm just guessing around, I didn't actually research about, say like it had something around 5,000 subsidiaries. And I have heard that SBI had forgot to actually consolidate few of its subsidiaries, say like five subsidiaries it forgot to consolidate, because SBI is that big, that huge, it might forgot, no problem. Okay, now they may recast the financial statement, because for complex entities or for complex MNCs and all, they might recast the financial statement, sorry, revise the financial statement. They may revise the financial statement. What is the difference between recasting and revising is that recasting is only that particular class of transaction or that particular account balances. Revise is it affects on various lines items. In order to say in language of misstatements with assertion level, say like there was recasting. Misstatements with regards to assertion level were recasting, and misstatements at financial statement level, that is revising. At that time you do revising. So at this time company might itself voluntarily revise those financial statements and all, because there would be a lot of misstatements that might happen in the complex entities, right? So they might do voluntarily revision of financial statement, but the time period for revision of financial statement is just 3 years. Why they have given only 3 years? Any guesses? Let me give you a hint. Peer review. Any guesses? Peer review. For every 3 years, peer review will be done for the auditors. Auditors do what? Audit of that company. If at all any kind of misstatements were there, peer reviewer will identify that. So that's why 3 years were given. So it's actually a logical process. That's the brain behind the lawmakers. Okay, that's why 3 years. If you don't want to link to the provisions that you have already learned, you could just leave that, and remember that revision is for previous 3 years, recasting is allowed for 8 years. Okay, what this question is saying, the question is saying that who had applied what, like the forensic auditor, yeah, the matter went to the court and they ordered for recasting. Could the court order for a recasting of financial statement? Yes, they could order for recasting of financial statement for 8 years. If at all, they could also go beyond 8 years, provided central government gives direction. Okay, these are all the provisions with regards to the recasting and revision of the financial statements. Now we'll see the answer with that. Okay, I hope you understood. Just tell me in the comment section whether you have understood recasting and revision of financial statements. Okay, yeah, you see, as per section 130 of Companies Act states that the company shall not reopen its books of account and not to recast its financial statements unless an application was made by central government or income tax authorities or SEBI or any other statutory or regulatory body, and an order has been made by a court or a tribunal. Okay, affect that. Why tribunal will give an order to recast or reopen its books of accounts? The earlier accounts were prepared in a fraudulent manner, or the affairs of the company were mismanaged, that they cast a doubt on the reliability of the financial statement. Here they know the fraud, what had happened in the accounts, or they know that what fraud, they don't know the fraud exactly what had happened in the financial statement, but they suspect that the affairs of the company was so mismanaged that their, okay, is there a problem with the sound? Is that okay now? Hello. Under these two reasons, tribunal might order for recasting and reopening of books of accounts, and the order for reopening of accounts shall not be made beyond 8 financial years immediately preceding the current financial year, unless until government has issued a direction they could go for beyond 8 years. Okay. Keeping in view of the above, these were all the provisions of the Companies Act under Section 130, reopening and recasting of financial statements. Keeping in view the contention of ALM Limited that Companies Act does not allow recasting for more than 3 preceding financial years is incorrect. The 3 years was voluntary revision of financial statements. Okay, and now we'll see the third question. Ram and Hanuman Associates, Chartered Accountants in practice, have been appointed as statutory auditors of Krishna Limited. Okay, for the accounting year 2019 to 2020, Mr. Hanuman, a partner of Hanuman, wait a second. Okay, now we'll see our third question. Ram and Hanuman Associates, these were chartered accountants firm, have been appointed as statutory auditor for Krishna Limited. Mr. Hanuman, a partner of the firm statutory auditor, hold 100 equity shares. You see, Section 141, eligibility to be appointed as auditor. You see here the partner is holding the equity shares. This firm would be eligible to be appointed as a firm? No, it would not be eligible to be appointed as an auditor because the partner is holding 100 equity shares. You see, the relaxation was given for the relative or to hold up to 1 lakh, right? That to be the face value of 1 lakh, but not for the partner. The person or the partner shall not hold equity shares. Okay. In what companies? All the company, subsidiary, holding, associate or subsidiary of that holding. Here Hanuman had hold equity shares in Shiva Limited, which is actually the subsidiary of the Krishna Limited, which had proposed to be appointed. So Ram and Hanuman Associates would not be eligible to be appointed as an auditor because statutory auditor, because the partner Hanuman has been disqualified for holding 100 equity shares in Shiva Limited, which is a subsidiary of Krishna Limited. Okay, you have to write the provisions that a person shall not be eligible for appointment because that person or relative or partner holding securities interest in its subsidiary or company, holding company, associate or subsidiary of such holding company. Okay, and the exemption was given to only relative but not to the partner, so that's why this firm is ineligible to be appointed. If at all they have already been appointed, they have to vacate their office immediately. Okay, and now we'll see, you see, Ram and Hanuman Associates would be disqualified to be appointed as statutory auditors as they were holding shares, right, equity shares in the subsidiary company. Now we'll see our next question. ABC and Company is an audit firm having partners A, B, C. ABC are holding appointments as an auditor in already companies, 4 companies, 6 and 10 companies respectively. Provide the maximum number of audits remaining in the name of ABC company. Okay, they are talking about the maximum companies, maximum threshold limit companies, madam. So for a chartered accountant, how many would be the maximum companies? 20 companies, right? 20 companies as per Act. Here, in total, the maximum number of audits that a company of 3 chartered accountants could hold is 60. Okay, here A was already holding 4 and B is already holding 6 and C is already holding 10. That is, they have exhausted the limit of 4 plus 6, 10, 10 plus 10, 20, 20. So the remaining were 40. The maximum audits that the firm, in the name of that firm, they could accept is 40 companies. The maximum number of audits remaining in the name of ABC company is 40, and the maximum number of audits remaining in the name of the individual partners were, okay, 20 minus 4, 16, 6 minus 20, 14, 10 minus 20, 10. Okay, And can ABC company accept the appointment of as an auditor in 60 private limited companies having paid up share capital less than 100 CR? Less than 100 CR, would that be included in that threshold limit? No. If it touches 100 CR plus 1, it would be included. Since it is less than 100 CR, they could accept all the 60 private companies. And two small companies, yes, small companies would not also be included, so they could accept small companies. Doormat company also they can accept appointment from. And would your answer be different if those 60 private companies, 45 are paid up share capital of 100 CR each? See, it touched 100 CR, that is plus 1, that is 45 plus 45. But here you see the maximum limit that the company, the chartered accountant firm could actually accept is 40 companies. So they could accept 40 out of that 45 companies, right? Yeah, now we'll see the solution with here. And they have just repeated the facts of the case, and with regards to the provisions, you see the threshold limit, you see the maximum is 20 companies, and though other than OPC companies, dormant companies, small companies and private companies having paid up share capital less than 100 CR, it's less than 100 CR. If it touches 100 CR plus 1, that would be added to that 20 list. Okay, you see 3 chartered accountants, total 20, so that the total audits that the company could accept is 60, but they have already accepted 20, so the maximum remaining audits that the firm could accept is 40. And individual were 20 minus 14 for A it is 16, for B it is 14, and C it is 10. Okay. You see, they are talking about the 60 private companies whose paid up share capital is less than 100 CR, so they can accept all this because the paid up share capital is less than 100 CR. If it touches 100 CR, then plus 1, 20, it would be added to the 20 threshold limit. And here they're talking about 45 companies, so they could accept for 40 private companies of having paid up share capital 110 CR in addition to that companies, right? Now we'll see our first question, that is Nick Limited is subsidiary of Ajanta Limited whose 20% shares have been held by central government. Okay, we'll just make a illustration here. Nick is subsidiary of Ajanta, okay, whose shares have been whose 20% have been held by central government, 20% by central government, and 25 by state government, UP state government, and 10% by Madhya Pradesh government, that is again state government. Total how much? 10 plus 20, 30, 45, 55. Yeah, 55% was by central government or state government. So it's a government company. Ajanta Limited is a government company. And Nick Limited appointed Mr. Prem as its statutory auditor, as an auditor. How would you deal with this above situation? See, Ajanta Limited is a government company. Subsidiary of that government company is also deemed government company. So who has right to appoint the auditor for a government company? C&AG has right to appoint the auditor for a government company. The board of directors of Nick Limited cannot appoint the statutory auditors. Okay, so we'll see the answer here. Yeah, according to section 139, the audits of government company shall be appointed or reappointed by C&AG. Here A government company is defined as a company which shall not less than 51% of paid up share capital is held by central government. Here in this case, above case it is 55%. Yeah, it total 55%. So it's a government company. Okay. Ajanta Limited is a government company. And NEC Limited is a subsidiary of that Ajanta Limited. So it is a covered under the government company. It would also be treated as a deemed government company. So the appointment of Prem is invalid, and he should not give acceptance to the directors of NIC Limited. Okay. C&AG has a power to appoint auditor for that NIC Limited. Now we'll see our next topic. Next question. C Limited appointed CA Innocent as an auditor for the company for current financial year. Further, the company offered him services of actuarial, investment advisory and investment banking. Where have you heard of these kinds of services? Section 144, right? Yeah, under section 144. But a person who gives actuarial services, investment advisory and investment banking services, could he be appointed as a statutory auditor? No, he cannot be appointed, which was also approved by board of directors. Okay, as an auditor, how would you deal with the above situation? Could he do that? So no, we have to first write the provisions of section 144. What are the list of section 144? First thing, accounting and bookkeeping services, and later on with regards to investment advisory and investment banking services, and with regards to internal controls, internal audit, actuarial services and information system, financial information system, and rendering outsourced financial services, management services. Okay, what does information financial system is? You see, it might be indirect, so that's why I'm explaining you what does information financial information system is. It's actually might be an application like an ERP software, like an Oracle software or an SAP. So that the auditor, these were the things, right? These were also a part and parcel of bookkeeping services. So the person who actually design and implement that financial information system cannot be appointed as a statutory auditor. Okay. And a person rendering outsourced financial services for a bank, say like credit card recovery agents, like they go and collect the actually the bills of the credit card holders who failed to pay, right? And they to collect the bad debts and all. So those also cannot be appointed as a statutory auditor. Okay. Why I'm explaining you these 2 points is that they might be asked you in indirect format, like some person is designed and implemented the system of application which runs the accounting and all. So it would might be asked in indirect format, or they have appointed some X and X person to collect the bad debts and all. Could he be appointed as a statutory auditor? No, that is rendering outsourced financial services. Okay, these were the services. So a person who provides these services cannot be eligible to be appointed as a statutory auditors. You see here, the auditor is advised not to accept the services as these services are specifically notified not to be rendered by him. That is the auditor. Okay, he cannot accept that appointment. Okay, now question number 7. Mr. Amar, a CA, bought a car financed at 7 lakhs by Chaudhary Finance Limited, which is a holding company of C Limited, Charan Limited and D Limited. Okay. Amar has been statutory auditor of Das Limited and continued to be even after taking that loan. You see, an auditor, how would you deal with this situation? First, we'll just make an illustration. Yeah. Chaudhary Finance Limited is actually a holding company for C Limited and D Limited. Okay. For D Limited, Amar was an auditor, right? But he had indebted to the holding company more than 5 lakhs, that is 7 lakhs. Would he be qualified to be appointed as an auditor? No. See, he could not be made indebtedness. The indebtedness covers company, subsidiary and associates, holding company or joint venture and subsidiary of that holding company. See, this is the holding company, right? So he is disqualified. to be appointed as an auditor for this Das Limited. Okay. Yeah. According to section 141, the person is not eligible for appointment as an auditor if he is indebted to the company or subsidiary or holding company in our case, and associate company or a subsidiary of such company in excess of 5 lakh rupees. In the given case, Amar is disqualified as he indebted to Chowdhury Finance Limited with more than 5 lakh rupees. He cannot be acted as an auditor for any subsidiary of that limited, here Charan Limited or Das Limited. So the audit work performed by Amar would be invalid. He should vacate the office immediately. Okay, these were they have asked us about the disqualifications. Now we'll move on to our next question, that is A Limited. A LLP is actually newly set up LLP. The operations of LLP have been picking up and management is currently in progress of setting up process and procedures in place. Okay, as per the understanding of management of LLP, its accounts would not be required to be audited mandatory. Okay, they're asking about LLP audit limits might be because of their operations, but still the management had decided that they would get their accounts audited voluntarily. Fine. In this regard, management would like to understand some of the aspects which should consider not only limited to the audit but also about the maintenance of books of accounts as per laws and regulations. It's actually a direct question. LLP maintenance of books of accounts under LLP and LLP audit. So it's actually a direct question. See, LLP shall maintain its annual accounts which should have a true and fair view. Okay. Provides that LLP whose turnover does not exceed 40 lakh rupees or whose contribution does not exceed 25 lakh rupees not require its accounts to be audited, but if it wants to get their accounts audited voluntarily, they could do that. So, and with regards to the appointment of the auditor, at any time, when they could appoint the auditor, at any time in the first financial year, but before the end of that financial year. Okay, at least 30 days prior of the end of the financial year is preferable. Okay, they have to fill the casual vacancy. They have to fill the casual vacancy that was either by resignation or by removal. The partners may appoint the auditors if designated partners have failed to appoint them. So, okay, here, wait. Yeah, now with regards to the books that have to be maintained by LLPs, you see all the particulars of all the money that have been received and the expended by the LLP, that is cash flow that they were indirectly talking about, and the record of assets and liabilities, balance sheet, statement of cost of goods sold, purchased, inventories, work in process, finished goods and cost of goods sold. These were P&L statement. If any other particulars which partners may decide, they could do so. You see cash flow statement, balance sheet and P&L statement. Okay, the auditor should also read the LLP agreement. You see LLP agreement is like mostly like partnership agreement. What all the things you have to read, you will see. The LLP agreement should consist of, with regards to the business, two things: nature of the business and the duration of that business partnership. Okay, and every other thing is with regards to the partners only. You see how much capital they have contributed. After capital contribution, the drawings like addition and negative also, the things, the money that partners had brought into the LLP and the drawings that they have withdrawn from the LLP. Okay, then interest on that capital that was contributed, and if at all any salaries, commission was payable to the partners, those details, and any kind of borrowings powers of that LLP, borrowing powers of LLP, rights and duties of that partners, and loans that were advanced by the partners. You see they have bought the money but not in the format of capital but in form of loans. Okay, and the method of settlement of accounts and profit sharing ratio. Okay, these all the things that the auditor has to look after in LLP agreement. Okay, now we'll see our next question. That's question number 9. CAG was appointed by D Limited as statutory auditor. While doing the audit of D Limited, CAG had observed that certain loans and advances were made without proper securities. Certain trade receivables, trade payables were adjusted in intersay. Okay, they have just netted off the things, and personal expenditure were charged to the revenue. As a company auditor, comment on the reporting responsibilities of CAG. Okay, this is mostly like this is an indirect question. Actually, this is actually an indirect question. We have to know, we have to just fish the points that relate to the points that have already discussed in the questions, right? In the duties of the auditor, in the duties of the auditors, the first line item which we see is inquire on certain matters, right? Let's see, I'll show you here. Yeah, inquire on certain matters. Yeah, now we'll elaborate what does that certain matters were. Okay, first, in order to do audit, what the auditor will have, say, balance sheet, P&L account, right? These were the things, these were the financial statements which auditor had went to audit. Okay, in balance sheet, what do we have? We have assets and we have liabilities, and we also have some equity that was there. Okay, now we'll talk about the assets first. Okay, were there any kind of assets that have been sold to the lesser than the purchase price, which were not immovable property? If at all immovable property, no problem in that, because depreciation would be there and obsolete of plant and machinery would be there, no problem. But what kind of assets we are talking about? We are talking about shares, and this company is holding shares of some entities, but this company is not an investment company. That is, these might be subsidiaries, or say like undertakings or joint ventures, or say like there might be an associates, anything. These assets were sold for less than the purchase price. These were certain matters that the auditor has to inquire on. First of all, the company. Why a company will hold shares? If it's a trading company or an investment company, but this company is not neither a trading company nor an investment company, but it's holding shares. Okay, it's holding shares, no problem. But why it is selling to less than purchase price? If at all they were like investment and trading company, they would be like there that is actually the ordinary course of business, so they will buy and sell the things and all, no problem in that. But it's not their ordinary course of business, but they are holding shares of particular company. That should be obviously be might be a subsidiary or undertakings, or like say joint ventures or associates. But they were selling that for the less than purchase price. Okay, in order to have reduce the profits, and evade the tax. Okay, okay, as we have said, we are talking about the assets, right? We have been talking about the plant and machinery and all. Now we'll go to the liability sides. Loans, we'll have some loans to be repaid. We'll put the plant and machinery and then take loan. Whether this asset that was secured, that was kept as a collateral, or those assets that have been pledged or hypothecated, were the loans that were taken, were they prejudicial to the interest of the company, were they prejudicial to the interest of the shareholders? We have to check for that again. All right, you see, these loans again, like they reduce the profit with so much of interest thereon, like, and then they evade the tax. All these tax evasion transactions that were there, that were included in this certain matters category. Okay, we are talking about loans, right? And I'll just explain you another type of loan which were included in this certain matters category. Okay, yeah, few, this is a company, and few outsiders had come and invested and deposited, actually they have deposited some amount in our company. Okay, you see, why do some people come and deposit in our entity? Say like if we are a construction company, the tender money would be there, they would deposit. And if it's our a gold shop, a gold company, people come and they have schemes, right? Gold schemes, you pay for 11 months, and then the 12th was free, and then on the 12th month you could buy a gold piece and all, right? These all deposits, some other external parties have been giving deposits in our entity, but we are showing these deposits as a loans that were taken by the company, and we are showing that as a loans, we are showing that as a loans, and we are charging the interest. With that interest, the profit is getting reduces, and we are evading the tax. That's again another point. Yeah, we have seen two transactions, two type of certain matters with regards to the liabilities, and one with regards to the assets. Okay, now we'll see one transaction with regards to equity in the balance sheet, and we'll just close. Okay, what, when equity shares were allotted for cash and the cash was not yet received, or you have to inquire on that matters, whether that was an agreement of debt restructuring or something, any other matter, we have to inquire on that. Okay, done with the balance sheet. Now we'll go to P&L account. In P&L account, whether any kind of personal expenditures were there have been debited to the P&L account, so that profit would be reduced and tax would be evaded, we have to check for that. Or any transaction that have been entered that were prejudicial to the interest of the company or the members, we also have to check for that. So these were the certain matters that were included in this section 143, and now we'll discuss it one by one, whether these all points were there or not. You see here, under section 143, law requires auditor to make inquiry on certain matters to be reported. You see here, with regards to the loans, whether the loans and advances that were made by the company on basis of securities have been properly secured or not, are first transaction. And here, whether the loans and advances were made to the prejudicial to the interest of that company, again first transaction. And whether any kind of personal expenses have been charged to the revenue or not, that is first transaction in P&L account. Okay, and the transactions which are prejudicial to the interest of the company or the shareholders, that second point which we have discussed in P&L account. These are all the things that they have given in the question, so they have just said the same thing, right? And they said we have to report under Companies Act under section 143 of inquiring on certain matters. Okay, in the meantime, we have just revised that section 143 also. Okay, yeah, B Limited decided to appoint Mr. R, a chartered accountant, as a branch auditor for the audit of its Lucknow branch. Okay, R is branch auditor. The decision to appoint branch auditor was taken by board resolution, no problem in that. Okay, and it was subject to the shareholders approval, obviously that's true. Meanwhile, the principal auditor raised an objection that branch auditor cannot be appointed without his consent. You see, statutory auditor is somebody, a third person, who have been appointed by the shareholders. You see, branch auditor should be appointed by the board of directors, no problem in that. Actually, there were no provisions in the Companies Act that the branch auditor appointment should be actually in consultation with the statutory auditors, or a statutory auditor has to recommend and all that. Audit committee has to make recommendations with regards to them, appointment, qualification, eligibility of the auditors, of internal auditor or statutory auditors or any other branch auditors. So no provision was there in that. So the contention of the statutory auditor here is wrong. Okay, whether the objection raised by the company auditor is valid? No, it is not valid. See, you see, in the instant case, B Limited decided to appoint R Limited by way of board resolution and on, and the objection raised by the company auditor is not valid as per Companies Act 2013, and board has authority to appoint branch auditor, but it should be approved by the shareholders in the meeting. That's what they have done. That's also okay. Now we'll move on with 11th question. See here. L Private Limited, okay, it's a private limited, is company based out of Mumbai. The company had an authorized capital of 200 lakhs and a paid up capital plus reserves of 95 lakhs. Okay, we'll just make a note out of it. Yeah, authorized capital, say like 200 lakhs, paid up share capital plus reserves 95 lakhs. During the audit, for the financial year, the auditor noted the following points. Okay, what they have noted. The company had taken total bank borrowings of 75 lakhs. Okay, borrowings were 75 lakhs, and the company received a new loan of 30 lakhs plus 30 lakhs. That's total 1 crore 0.5 lakhs, 105 lakhs. And the project was shelved due to some technical reasons, and the whole loan was repaid on the same date. Okay. During the financial year, new proceedings were initiated against the company for holding Binami property worth 2.5 crore. Okay. The company's legal team had advised that the case would not withstand the law, would be dismissed during the hearing in April for the next financial year. Okay. The company had incurred a cash loss of 39 lakhs for the financial year compared to the cash profit of 15 lakhs in the previous financial year. The total turnover was 45 crore. The turnover is 45 crore. Okay. During the year, Y&S Associates had offered to resign from acting as company's auditor. Okay, however, they have later on decided to postpone their resignation to the following year. At the conclusion of audit, there was a difference of opinion between two article assistants who were assigned to the engagement concerning and disclosing the points mentioned in CARO 2020. Okay, we have to first check whether CARO is applicable or not for this company. Okay, Jack was the opinion that the proceedings initiated under Binami need not be disclosed, since the expert legal team had confirmed that this case would not withstand the law. However, he insisted that the cash loss should be disclosed along with the amount. Jill was of the opinion that CARO is not applicable to that company, hence nothing needs to be reported. Okay, they both approached the firm's partners to resolve this argument. First, what we have to check? We have to check whether CARO is applicable or not. Okay, when is CARO applicable? Since CARO is applicable to all companies, including foreign companies, except a private company having paid up share capital plus reserves that is not more than 1 crore. That is not more than 1 crore is, if it is less than or equal to 1 crore, CARO is not applicable. Okay, and its borrowings were not more than 1 crore. That is, if it's less than or equal to 1 crore, not applicable. You see, not more than is equal to less than or equal to, right? Okay. Borrowings. Then total revenue. Revenue is not more than 10 crore. That is less than or equal to 10 crore. Okay. You see, authorized capital, we do not look for authorized capital. We look for paid up share capital. Paid up share capital plus reserves is 95 lakhs. That is less than 1 crore. So under paid up share capital, CARO is not applicable. Okay, we'll see other conditions also. For borrowings, at any time, at any point, it has to actually meet, it has to exceed 1 crore. You see, even the loan was taken and repaid on the same date, even at that date also, the loan was 1 crore and 1.05 crore, right? It crossed and it touched 1 crore. So under borrowings, CARO is applicable. And the turnover also, it had it had touched 10 crore limit. So this is also applicable. And we have to also check, since the turnover is yeah, that's it. So for this company, caro is applicable because borrowings have crossed the limit or they have exceeded for 1 year. We'll see whether they have given that or not. Yeah, they have given the eligibility. Caro is applicable to all companies, including a foreign company, except banking, insurance company, and Section 8 companies, and one-person company and small company, and a private company. All the limits that we have set. Okay. You see here. Yeah. Paid up capital is less than 1 year, that is 95 lakhs, not applicable. Borrowings, they have exceeded 1 year, 1.05 year, so caro is applicable under there. And turnover is also, they have, it is 40 lakhs, 40 cr, that is, even that is applicable, that is more than 10 cr, right? As per clause 1e of para 3 caro, the auditor shall, so what do they have to report? They have to report under caro. Okay. Binomy transactions. Binomy transactions have to be reported under which clause? Binomy transactions have to be reported under clause 1, because in binomy transactions we have some PPE, right? Yeah, in PPE and immovable properties, they were mostly discussed there. Last point, right, in binomy transactions. See here, clause 1 point E, the proceedings that have been initiated under Binomy Transactions Act. So they have to report the binomy transactions under clause 1 point E. Okay, and then later on the auditor had resigned. Caro auditor resignation, clause number 18, right? You have to report that. And cash losses, you have to report under clause 17 of the cash losses that they have incurred. Okay, these are the things that you might have to report. But see here, the resignation have been postponed to the next year, right? So the resignation had not yet been there. If at all the resignation, if at all the auditors had resigned, then they have to report under caro. But they have postponed the resignation to next year. Yeah, where is this? Where is in the point, right, man? Yeah, they have postponed their resignation to the following year. That's it. That means that the resignation had not happened in current year, so they need not report the forthcoming resignation. What they have to report? They have to report the cash loss that for that financial year and the binomy transactions proceedings were there. Okay, they have to report those two things under caro. First of all, in this question, it's a lengthy question. What we have checked? We have checked the caro applicability, and second thing, we have checked the cash losses, right? Cash losses, and then we have to report for the binomy transactions. And then later on, with regards to the resignation, it's a tricky point there. Resignation was the thought of resigning, but they have not resigned. Okay, that's one thing. And these were the points that we have covered in question number 11. It's an important question. It's actually so much indirect, right? Okay, now we'll see question number 12. You are a part of engagement team conducting a statutory audit of a branch of a bank. During the course of audit, it has come to your notice that a large number of cash credits in the branch. Okay, many of the cash credit accounts are not only actually are only partially utilized during the substantial part of the year. Okay, however, the month March, the accounts are fully utilized. On further scrutiny, it is observed that these account holders have made fixed deposits from these utilized amounts at the year end. Okay, these deposits have been liquidated in the first week of April of the next financial year. Okay, I'll explain you this scenario. First, what the bank manager had done. Bank manager, in order to actually cope up with the targets and all, he had asked everybody, all the persons in his area, to open the CC account. For CC accounts, it's the things were very the what like the regulations or the compliances to meet were very low. Even a small retail shop owner could open a CC account. What how actually a CC account works is that it's mostly like it's actually like say like a current account, but where it's overdue. Okay, it's overdue. Say like you actually pay the purchases from this account, and all the sales would from come and fall in the CC accounts, and in the CC account the portion that the actually that the client that had utilized, that interest would be debited. This is how actually a CC account works. CC account is mostly like a current account where you could utilize excess of that, excess of your bank balance, right? This is how actually a CC account works. Okay, the CC account where, as I said, this is how CC account works. You might have thought that the CC account should be like in progress or in action throughout the year, because business happens throughout the year when all the purchases will goes on every year, every day, and sales also comes in every day, right? These were everyday transactions that has to happen in CC account. But see here, what the auditor had observed is that they have not been utilized at all. They have been partially utilized for the substantial part yet, but they have utilized in the month of March. That is, they have been exhausted the CC account balance and then deposited and liquidated in the month of April. That is, this is clearly a window dressing concept that was utilized by the bank manager in order to increase the CC loans account. Okay, whether it be for like a window dressing of financial statement or like financial reporting, financial ratios and all. Okay, we'll see how to deal with this. It's actually in October 22 MTP. Okay, in the given case, many of the cash credits accounts in the branch of nationalized banks are partially utilized for the substantial part of the year. The fact of the case, however, in the month March they were fully utilized. That is, the clients who are there, they have withdraw the whole CC limit. Okay, it is observed that these account holders have made FDs from that utilized amounts at the year end. Okay, these peoples have liquidated in first week of the April of the next year. You see, they have fixed deposited the same CC limit in the same bank. That is, FDs were more. So people were coming and infusing money in that bank. It's a window dressing. It's something that's healthy, right? They were shown to be healthy. Okay, this is an example of window dressing. The branch is resorting to window dressing by artificially boosting its advances and deposits. Okay, utilization of advances and placing of fixed deposits at the year end. The auditor has to verify the unavailed portion of CCs to boost the loans and deposits. You see, the same has to be reported in the LFR, and they have to make a qualification in the audit report also, because it's actually a window dressing. Okay, now we'll see our question number 13. J Private Limited was engaged in business of cycles. C.A. Roy was appointed as statutory auditor of the company. During the year, J Limited obtained working capital from Bank Limited for 10th year. You see, 10th year for hypothecating of stocks of as its primary security. On inquiry, C.A. Roy was informed by the management that stock statements are furnished periodically to Bank Limited, and the details of submissions of stock statements were given below. You see, have you got triggered for any quantum right here? You see, 10th year working capital was more than 5 years. That is, you have to report under CARO clause 2 inventory, second point, right? Yeah, I will just show you the CARO second point here. If at all the working capital limits was more than 5 years, then what they have to do, auditor has to check whether the stock statement that was submitted by the management to the bank have to be in line with the books of accounts or not. See, during the at any point of time when the sanctioned working capital limit is excess of 5 years, then the quarterly returns or the statements that were filed by company to the banks, whether they were in agreement with books of accounts of the company or not, you have to check that as an auditor. Yeah, here you see these were as per books of accounts, these were as per quarterly statements. They were not in agreement with the books of accounts, right? The stock statements were not in agreement with the books of accounts, so there you have to report the excess or deficit, right? The difference amount. You see, the management of private limited J company did not disclose the above variations in note to accounts in its financial statements. The management replied that there are no variations in balance sheet date, and the further they are in view that the stock statement furnished to a bank is just a formality and computed arbitrarily only for the purpose of securing higher drawing power. Okay, hence the statutory auditor need not be bothered. You see, first you have to write the provisions, that is clause 2.2, right? Working capital more than 5 year water has to report so and so matter, and you have to just apply that to the case here, and you have to give the variation how you have to report. Okay, this is so simple, it's a simple question. And now we'll discuss 14th question. You're appointed as an auditor for XMP Private Limited for financial year after resignation of RS and Co. Okay, previous auditor is RS and Co, I guess. As statutory auditor of the company, RS has certain concerns on accounting matters of the company, leading to change of auditors. All the compliances under section 113 and 140 made by the company in regard to the resignation and appointment. Okay, during the course of audit, it came to your notice that a survey has been conducted by the income tax department, and the department has unearthed unrecorded sales of 5 lakhs which have been made in cash on different dates. Okay, there was some undisclosed income. Okay, and there was also a resignation of auditor that had happened. Okay, they have purchased gold, the company had purchased gold from those collection of 5 lakh rupees, and these transactions were not recorded. Okay, the company surrendered and disclosed these transactions before the assessing officer and the paid taxes thereon. Okay, however, the company has not recorded those transactions in books of accounts even after surrender before income tax authorities. What would you want to report the above matters in Caro? Yes. Okay, two matters have been happening there. First thing is resignation of the auditor. Second thing is they have disclosed the undisclosed income. Okay, these two things you have to report. You see, resignation of auditors is clause number 18, and the disclosure of undisclosed income is clause number 8. Okay, you have to write with regards to that. You see, in the given situation, private limited had resigned due to some concerns and all, and that's it. These were the things you have to write, the reasons for resignation and all. You have to just report it in the Caro. And in clause 8, that is with regards to the undisclosed income, you have to deal with that also. Yeah, clause 8. And now we'll discuss question number 15, that is A private limited has fully paid up share capital of 140 lakhs during the year. Okay, we'll just make a note out of it. Paid up share capital is 140 lakhs, and it had borrowed some 15 lakhs from a bank and 15 lakhs from a financial institution. See, from a bank 15 lakhs, and from a financial institution 15 lakhs. It has a turnover net of GST 50 lakhs which have been credited to a separate account of 475 lakhs. You see, GST, is that our revenue? No, we are collecting on behalf of government. GST is revenue of the government, not for our company. So net, we have to give the net figure only. Turnover is 475 lakhs. Okay, will company's auditor, okay, say, will Caro 2020 applicable to A Limited? You see, Caro is applicable to all companies except banking, insurance and OPC companies, electricity companies, small companies, right? You see, this is a private company. We'll check like paid up share capital less than 1 CR, borrowings were less than 1 CR, and turnover is also less than 10 CR. But see whether this comes under small company also. You might also go and check for that also, if at all it's not a private company or if it's a public company. You might check whether it's a small company or not. I'm just giving you a hint, but here if you check these three things, it would be more than enough. Okay, if at all private limited is not there, since all questions were asking about private and private, I'm just I'm just modifying you the question. Okay, if at all private is not there, even it's a public company, if it's a small company, see here, turnover is less than, small company, when you call it's a small company, when its paid up share capital is less than 4 cr and its turnover is less than 40 cr, if it's a small company. Is that a small company? A small company. For small company, Caro is not applicable. Okay, for this A limited, since it's a private limited company, we have checked all these things, and it had not crossed the threshold limit, so Caro is not applicable for this company. Okay, and now we'll see our see. Sorry, this is 140 lakhs, right? 140 lakhs is more than 1 cr, so Caro is applicable to this company. Okay, Caro is applicable to this company. That's my bad. Okay, excuse me for that. Okay, see, considering the paid up share capital, it has 140 lakhs is more than 1 cr, so Caro is applicable for this company. Okay, a term loan was obtained from a bank for 80 lakhs for acquiring the R&D equipment, out of which 15 lakhs was used to buy a car for use of concerned director who was looking at R&D activities. You see, car is not a R&D equipment. Okay, so the purpose have been changed. They have diverted the funds. As a statutory order, how would you report this under this Caro? You see, utilization of term loans. You see, under clause 9 is default of the loans. Under that section, what you have, whether company has defaulted any loans, whether the company has been declared as a willful defaulter by the bank, and whether any kind of short-term loans that have been taken used for long-term purposes or for the purpose have been deviated. Here the purpose have been deviated. Okay, you see here. The author should examine the terms and conditions of that term loan for utilization of the loan. You see, the purpose of R&D has been utilized for purchase of car which has no relation with R&D equipment. So the car cannot be used for R&D equipment. So 15 lakhs was not utilized for the intended purpose. You have to just disclose that in clause number 9, okay, of Caro. And now we'll see our next question. That is, physical verification of only 40% of inventory has been conducted by company. The balance 60% will be conducted in next year due to lack of time and resources. Okay, as a statutory auditors, how would you report under Caro 2020? You see, inventory clause number 2, right? First point, that is physical verification at reasonable intervals, and if any discrepancies more than 10%, whether they have been properly dealt in books of accounts or not. Okay, this point we have to just copy paste and we have to memorize the point, and then we have to write it here and we have to apply that here. You see, at reasonable intervals, all reasonable interval was presumed that yearly once. You see, at least once in a year, all the items, all the material items. All right, so they have not physically verified the things, and so Caro 2020 they have to report under Caro 20T as they have not fulfilled such criteria of physical verification for all the material items, right? So the physical verification was not reasonable, so that might impact the financial statements. You see, why we have shows once in a year is that, you see, management assertions, say like management, what all assertions that the management will give completeness, accuracy, valuation and all, right, in once in a year. Once in a year financial statements contain inventory balance also, right? When you are not doing a physical verification of 60% of inventory, but you are claiming, the management is claiming about the correctness of the balance of evaluation of that inventory and the completeness of inventory, how could they claim that? So the financial statements and the management representations and management assertions were not reliable. So that's why they have to report in Caro. Okay, now we'll see our next question, that is T Private Limited paid up share capital plus reserves is less than 50 lakhs. Okay, paid up share capital plus reserves and surplus. Paid up share capital plus reserves and surplus less than 50 lakhs, and it has no outstanding loan exceeding 25 lakhs. Okay, and its sales is 6 year. Okay, you see, I think they are asking about the Caro applicability. You see, it's less than 1 year, outstanding loans were 25 lakhs, that is less than 1 year, and its sales were 6 year, that is less than 10 year. Before deducting trade discounts, sales returns, and services rendered by the company amounted to 10 lakhs. You see, before deducting, right, 6 year less 10 lakhs, say it in 600 lakhs. 10 lakhs, we have to deduct the trade discount, and sales returns 95 lakhs, we have to deduct that, and services 10. So total it amounts to how much? How much does it amount to? It amounts to 5.05 CR, 505 lakhs. Okay. So Caro is not applicable because it is below 10 CR. Okay. Now we'll see next question, that is ABC Limited is in practice of maintaining consistent dividend payment, that is minimum of 14% in the financial year. The financial year 2019-20 was very bad for the company, that it was not possible for the company to maintain the payment of consistent dividend as above. Okay, the management, being hopeful for recovery of its performance in next year, felt that depreciation of the year to the extent of 75 alone is to be charged in the statement of financial statements, and remaining 25% have to be kept in separate account. Okay, can they do that? So no, they cannot do. Even as per Ind AS and AS accounting standards, depreciation, and moreover, even as per direct tax also, depreciation is cannot be charged at discretion of the management, at the discretion of the company. Depreciation has to be charged. It has to be, must be charged. It is not a discretion charge. Okay, it has to be charged. Okay, depreciation has to be charged. Moreover, dividend has to be declared out of profits which have been reduced by the depreciation. Okay, since they have not reduced the 25% depreciation, they cannot do that. So they have to reduce whole 100% depreciation, and from the remaining balance they have to declare the dividend. Okay, 2 points to be to be said. Okay. The management was of the view that it would be in fair practice of accounting if the depreciation for asset is charged before the expiry of life of assets, and the amount parked in assets code would also be unfailingly be adjusted to the revenue before close of next financial year anyway. Okay, they wanted to defer this depreciation to next financial year, and they want to defer before expiry of before the life of that asset. Can they do that? So no, they cannot do unless the issue. You see, dividend cannot be declared by company in any financial year except from the profits of the year after providing depreciation out of profits of any previous financial year, or any after providing the depreciation. Okay, but here they were saying they will not provide depreciation of 25%, which is wrong, which should not be done. The contention of management is not tenable. This is just the facts of the case, that what they have discussed in the question, and the practice of the company is not charging depreciation and accumulating to 25% is not acceptable accounting treatment also. Therefore, the auditor of the company shall ensure the compliance of the provision, that is, they have to charge the 100% depreciation. If at all management do not comply, then auditor shall qualify his report accordingly. Okay, that's it. And now we'll move on with our next question, that is question number 20. The financial statements of MP Limited are to be prepared under Division 1 of Schedule 3 of Companies Act 2013. Comment on the disclosure compliances. Disclosure compliance was Schedule 3 compliances from following information in the financial statements which are required to be drawn up in compliance with Ind AS. Okay, first, what was that? PPE include 2.5 CR for boiler plant under construction. You see, out of any kind of assets, they have to be separately disclosed. Okay, so they have to not include. Whether is that the same thing? The boiler plant under construction should be under the heading of capital work in progress instead of including in PPE. Okay, so that is not in order. Okay, cash and cash equivalents include 1.25 CR deposited with bank having maturity of 18 months, more than 12 months, normal operating cycle. You have to disclose that separately. You have to not include that. You see, after that, repatriation arrangements and all, the last one is in any kind of cash deposits that you have deposited with the bank having maturity more than 12 months have to be disclosed separately. So we'll see whether they have said that right or not. The bank deposits with more than 12 months maturity shall be disclosed under the other financial assets. They have to be disclosed separately. And non-current assets include under the caption biological assets other than bearer plants. Biological assets which Ind AS 41. Okay, a sum of 1.5 CR being cost of cultivation bring to yield the cashew trees whose yield period shall not be less than 10 CR. Okay, under Ind AS 41, how do you actually account for biological assets? Okay, we'll go with Ind AS 41 here. They have to be valued. You see, this cashew trees were biological assets, right? In the question they have said that. Yes, in this question what they have said, biological assets other than bearer plants. Okay, whether this biological Ind AS 41 is applicable to biological assets or not. See, this standard, this is actually I have downloaded from MCA website. Yeah, Ind AS 41, this standard shall be applied to biological assets, does not apply to bearer plants. What they have given in this question. Yeah, they have given that it is biological assets other than bearer plants. So which Ind AS would be applicable? Ind AS 41 would be applicable. In Ind AS 41, how this would be valued? They will be valued at fair value less cost to sale. You see, a biological asset shall be measured at initial recognition and the end of each reporting period, fair value less cost to sell, but not the cost that was incurred, right? But they have to not add the cost that was incurred for the cultivation and all. That is, they have to be, these cashew nut trees have to be valued at fair value less cost to sell, but not, they have to not capitalize the expenditure. Okay, we'll see whether they have given that or not. The cost of 1.5 CR for cultivation cashew nut trees shall not be considered as biological asset, therefore it should be shown under the heading PPE, right, as bearer plants as per Division 2 of Schedule 3. You see, this cost should be shown under PPE, but not for the biological assets cashew nut trees. Okay, and now we'll move on to next question. That is again, see, the balance sheet extract of S Limited required to prepare financial statements under Ind AS. Comment the presentation of the terms. You see, under PPA they have given trademark. Trademark is intangible assets. Was that in order? No, trademark is not to be classified under PPE. Okay, they have to be classified under other intangible assets. Okay, other non-current assets, bank deposits with more than 12 months maturity. You see, now only we have discussed that bank deposits having more than 12 months maturity have to be disclosed under other financial assets, but not under non-current assets. Okay. And with regards to equity, share options outstanding. Okay, we'll see in the schedule. Yeah. Shares options outstanding account not to be classified under equity, they have to be disclosed under other equity. Okay. And other current liabilities, application money received for allotment of securities to the extent refundable and interest accrued thereon, where they have to be disclosed. They have to be disclosed under other financial liabilities. Yeah, they have to be disclosed under the other financial liabilities. Okay. And now we'll see our next question, that is question number 22. That is, Gautam Limited had borrowed 1000 CR from bank and the principal was repayable after 5 years and the interest was payable at the end of each year for the 4 years. And Gautam paid interest for all the years on the time and defaulted fifth installment. Okay, defaulting the loan. Which clause? Defaulting of loan. Clause number 9. Caro clause number 9. And the principal amount. Okay. Gautam Limited approached the bank to restructure its existing liability and they restructured into a new account of 1100 CR and the management did not provide any disclosure. Whether they have to give disclosures? Yes, they have to give disclosures because you see it's a public company. Gautam Limited is a public company, right? Caro is applicable to all companies and moreover it has defaulted the loan under clause 9. Caro clause would be attracted, so they have to disclose that. And during the statutory auditor, the auditor had found this transaction and obtained the relevant documents and understood that they have defaulted and they have applied for the restructuring of that loan account. In the light of above scenario, kindly guide the statutory auditors in reporting the transaction. Same clause 9, they have to report that how much amount they have defaulted, for what amount they have defaulted, and who is the lender, nature of borrowings, and the amount not paid on due date, and whether it is a principal or whether it's an interest, and the delay, and the remarks, any kind of things. This is how they have to disclose. And now we'll see our next question, that is question number 23. What are the reporting requirements in the audit report under Companies Act and Caro 2020? Okay, for the following situation: a fraud had been committed against the company by a vendor of the company. You see, fraud. For Caro 2020, which clause would be attracted? 11. Whether company is doing fraud or some fraud had happened on company, both have to were covered under Caro 2020 clause 11. Okay, in Companies Act, auditor less than 1 CR, more than 1 CR, they have to communicate within 2 days of their getting knowledge with regards to that fraud, and the board has to respond within 45 days, and they have to disclose the nature, amount, and the parties that were involved. In the board report, they have to disclose the nature, amount, and the parties involved, and the remedial actions that were taken. These all the things you have to write. Are you getting triggering the point, whether you have heard it somewhere, right? Yes. And the company has committed a major fraud on its customer. You see, company made a fraud and there's a fraud that was made on the company. Both has to be disclosed. You see, under clause 11, they have to disclose all these things. And what they have to disclose: first thing, whether a fraud had happened or not, and second thing is they have to disclose form ADT 4 has been filed or not. Okay, these were the things that you have to report in clause 11 of Caro under Companies Act. All the procedures we have said, right? All the 45 days, 2 days, and if at all it's more than 1 year, they also have to communicate the matter to the central government, right? These all the things you have to write. Now we'll move on to our next question, that is question number 24. Mr. Rajun was appointed as engagement partner on behalf of B company, that is B&Co chartered accountant firms, for conducting a statutory auditor of S Limited, an unlisted public company. Mr. B, one of the senior engagement team members, was given the responsibility to audit matters as per requirements of CARO. Okay, he made the following observation that are relevant for reporting under the audit. Okay, he had made some observations. We'll see whether how they would be reported under CARO 2020. One of the plant and equipment taken on lease by S Limited was revalued based upon the valuation of register valuer. No problem. See PPE, which clause? First clause. Okay, they have revalued. Okay, revaluation was done. Revaluation, if it is material that is more than 10%, we also have to check whether they have been properly accounted in books of accounts or not. Okay, and net carrying value of PPE is 4 CR. Okay, to 4.45 CR, that is 45. 4 CR into 10% is 0.4 CR, but it is, they have increased is 0.45 CR, right? That is more than 10%. So it's a material revaluation, they have to report in the CARO, clause number 1. Okay, and the second observation is during the year under the consideration, the cash credit limit under was 5.5 CR. You see again clause number 2, second point, what working capital limit was more than 5 CR. What they have to do, they have to check, the auditor has to check whether the statements that were submitted by the company to do bank were in line with books of accounts or not. Okay, was sanctioned by the DMC bank based upon the security of current assets, was reduced to 4.5 CR after 6 months. No problem, at any point of time if it touches 5.5 CR, this CARO is applicable. In connection, quarterly returns have been filed by the company which are in agreement with books of accounts. Yes, we have to report that the same thing in those two matters. Okay, and now we'll move on with question number 25. Pearl Limited is an exporter of precious stones. The turnover of the company is 150 CR, out of which 105 CR is of from export business. Okay, how much percentage? 105 by 150 is 70%, right? And remaining 45 was from domestic sales. The amount received from the export business is in foreign currency. Okay, that's a proper export. Okay, directors of P Limited are of opinion that cost audit is not applicable. Okay, in what all the situations cost audit would not be applicable, if at all? The export turnover is more than 75%, or if it is doing business in cess, or if it is doing electricity if it's an electricity company doing capitative generative plant, then in these three scenarios the cost audit would not be applicable, that would be exempt for these three companies. But see here, the export turnover is just 70%, it's not more than 75%. So for this company, cost audit would be applicable. Okay, cost audit rules would not be applicable if it is, yeah, they are saying it's 70%. Okay, cost audit rules would not be applicable if the turnover is more than 75%, but here it is 70% only. Okay, so thus the opinion of the director is not tenable. So since it's below the prescribed limit of 75%, cost audit is applicable for that P Limited. Okay, now we'll see our next question, that is 26. Petrol Limited is in engagement of generation of electricity for captive consumption through captive generating plant. Okay, the company is also maintains cost records in books of accounts, and Mr. X, friend of MD of the company, suggested name of his brother who is a cost accountant in practice for the purpose of cost audit. However, the statutory auditor of the company is of view that company is not legally required to conduct cost audit. Yes, right, it's an electricity generating company through a captive generating plant. It is exempted from cost audit. Yes, what the statutory auditor said is true. Now the MD is in dilemma about the requirement of cost audit. Being an expert in cost audit records rules, you are required to guide in this record. See, you have to write the same provisions. Revenue from exports for more than 75%, operating in SEZ, are engaged in generation of electricity for captive consumption through captive generating plant. These were exempt. So they fall under the exemption criteria. Non-applicability of cost audit is correct. Okay. And now we'll see our next question, that is Mr. Khanna has been appointed as statutory auditor of R Limited for the financial year ended 31st March 2021. The financial statements are to be drawn up in compliance with Ind AS. Okay. The CFO is of the view that the disclosure requirements specified under Division 2 of Schedule 3 of the Companies Act are complete and not require additional disclosures shall be made in the notes to account or by way of additional statements. Advise the general instructions to be considered while preparing the financial statements. You see, they're talking about the general instructions of the financial statements where for a company for which Ind AS is applicable. Now we'll go to the Schedule 3 where I have highlighted the things. This PDF is also shared in the Telegram channel. You might get that. I don't know guys, today the mouse and the pen both have been giving problem to me. Yeah, these were the general instructions. Yeah, these were the general instructions for preparation of financial statements for which Ind AS is applicable. First thing, they shall be prepared in accordance with this schedule, that is Schedule 3, first one, general instruction, and the compliance of this act if requires any kind of change. You see, then this schedule should be modified accordingly. You see, this Schedule 3 do not override the act. Act is above this schedule. Okay, Schedule 3. So if at all act requires any modifications, you might make modifications in Schedule 3. Okay, the disclosure requirements in this schedule are in addition but not substitution for the any kind of disclosures that were required under any act. Okay, and this note shall contain information in addition in form of narrative or any kinds of items. Okay, and each item in the financial statements shall be cross-referred to the related information. Okay, and there are rounding of provisions which we have discussed in our monetary limits also chart, and the financial statement shall contain the corresponding amounts, that's of amounts of preceding years. In our keyword kit also we have discussed about the difference between corresponding and comparative figures, right? Yeah, you might go check that video also. It is very good video of that. And the financial statement shall disclose all the material items. Materiality depends upon the size and nature of the things. So these were all the general instructions. See, first of all, what are those? If at all it's applicable under Ind AS, they have to prepare financial statements under this schedule. If at all an act requires any kind of additional disclosures or any kind of modification, you might modify the Schedule 3. The disclosure requirements in this schedule are in addition but not substitute, and notes to accounts shall be cross-referred to the related information and the rounding of provisions, and yeah, and you have to also disclose the corresponding amounts and the material items also. These were the general instructions. And now we'll move on to the next question, that is question number 28, that is M Private Limited seeks your advice while preparing the financial statements. General instructions followed in preparing the balance sheet of current assets and current liabilities. You see, again we'll go to Schedule 3. General instructions in preparation of balance sheet, that is yeah, you see, first point is, in order to classify an asset as a current asset, first it has to be expects to realize you have to realize that asset in normal operating cycle, and you have to be this asset primarily hold for the purpose of trading, mostly like inventory they are talking about, and this asset expects to realize within 12 months, and the asset would be a cash or cash equivalent, and there should not be any restriction for any kind of exchange or any restriction to settle any liability. Okay, when these 4 points were satisfied, then it would be treated as a current asset. First thing, it should arise from a normal operating cycle, and it should be actually for the sole purpose of trading, and it have to be realized that from 12 months, and there should not be any kind of restriction to exchange and settle a liability. And with regards to the current liability, what is the things you have to settle that liability in the normal operating cycle. Here for asset, you have to realize, you have to expect that in the normal operating cycle. Here the liability, you have to settle the liability in the normal operating cycle, and this liability is only for the purpose of trading. Okay, this liability is due, which was due will be settled within 12 months, and it should not have any unconditional right for deferred settlement of that liability. If the company wishes to settle that liability within the current accounting year, it should settle. There should not be a right or somebody else on that liability that we are holding, that you should not settle that. You have to defer that settlement to next year. There should not be any unconditional right with regards to settlement of that liability. And these 4 points, these were the general instructions in preparation of balance sheet with regards to current assets and current liabilities. Normal operating cycle being traded and 12 months, and there should not be any kind of restrictions thereon. And now we'll see our next question, that's question number 29. Z Limited changed its employee remuneration from 1st April 2019 to provide 12% contribution to PF on leave encashment also. You see, usually as per PF provisions, 12% has to be given on salary. What is leave encashment? Leave encashment is a salary that was earned by the employee but by not utilizing the leaves. You see, salary would be mostly calculated for like 28 days in a 30-day month. Say like that 2 days were leave that was granted, but such employee worked in these 2 days also and earned extra salary. This extra salary is leave encashment. That is, they have encashed the leave that was given by the company by working on. Okay, but what the company was doing, okay, now what company has changed its HR policies to that it also want to give this 12% of PF not only on the salary but also in this leave encashment also. Okay, as per leave encashment policy, the employees can either utilize or encash it. Okay, they can utilize the leaves in next month, or they might encash or they may convert that into cash, and they can do that. As at on the 31st March 2020, the company obtained an actuarial valuation for leave encashment liability. Okay, however, it did not provide for 12% PF contribution on it. You see, there was a liability that they have realized on the leave encashment. You see, there were few employees that who have worked on that leave and had created some leave encashment liability on the company. As per HR policy, it has to contribute 12% to the PF, right, on that liability. But the company had not done so. That's so. The author of the company wants to provide it, but the management replied that what if the employee avails the leave encashment? That is, what if the employee take the leaves of that the work the leaves in next month? The management doubt was that. Okay, the company further contends that the correct treatment is not sure whether the employees will avail the leave encashment or utilize it. Okay, this is actually a contingent liability. Okay, how we have to do that is, first, leave encashment liability had already been there in the books of accounts. So what the company has to do, company has to, as per provisions or as per its rules, has to provide the PF, but company had not done that. What the company has to do, the company has to provide that PF, but if at all there were any fluctuations in the liability, if at all the employees utilize those leaves, then the contribution has to be reduced or adjusted to that next year in which or to that next month when they actually utilize those leaves. Okay, so it's actually a on and on process. You might have been doing the employee benefits, right? Employee benefits in days 19, the same problem, right? Yes, in days 19 employee benefits, they were talking about that. Since the company obtained actuarial valuation on the leave encashment, it is obvious that the paid absence were accumulating. That's why there's a balance of leave encashment liability had arisen. An enterprise should measure the expected cost of accumulating paid balances. You have to expect that. This is not an actual 100% valuation, because they go on and on change. Okay, that's actually a contingent thing, and the additional amount of that enterprise expects to pay as a result of unused entitlement that has accumulated in the balance sheet. Here Z Limited will accumulate the amount of leave encashment benefits, as it is the liability of the company to provide 12% PF on the amount of leave encashment. Hence, the contention of auditor is correct. The full provision should be provided by the company. Since a liability exists as per the act, they have to provide 12% PF. They have to provide that. They should not just contract and say that they might utilize that and all. These all the things you should not say. You have to make a provision. If at all that they utilize, you could adjust that amount. Okay. That's why we are calling it as a provision. This is not an expenditure. You are just expecting that could be the things, right? And now we'll move on with our next question, that is question number 30. K Limited has 5 subsidiaries as on 31st March 2020, and the investments were in subsidiaries are considered as long term and valued at cost. Okay. 2 of the subsidiaries had net worth eroded, okay, and the prospects of their recovery are very bleak. That is, they cannot recover the investments that they have made. Okay. Otherwise, other 3 subsidiaries was exceptionally doing well, and the company did not provide for the decline of the value of investment. You see, in 2 subsidiaries, because the overall investment portfolio in the subsidiaries did not suffer any decline. Okay. What they were saying is that they have 5 companies. Okay, they are treating all these 5 companies as a single unit, and they do not want to do impairment testing, if at all, on 2 companies which had negative net worth, because the other things were doing well, and they treated this whole 5 companies as a single cash generating unit instead of 5 cash generating units, which was actually true. Company A is a one cash generating unit, company 2 is another cash generating unit, but what they have done is they have treated whole investments as a single cash generating unit, and they are not doing impairment, because the whole investment cost was still less than the net fair value, net realizable value, because the exceptional work performed by 1, 2 and 5 companies. Okay, but how actually you have to do is, as per financial instruments thing, each Ind AS 36, I guess, Ind AS 36, yes, Ind AS 36 of impairment, what you have to do is that you have to treat each company as a single cash generating unit and test the impairment for that. Okay, so that 3 and 4 would be tested to the eligible to be impairment testing. Okay. Now we'll see, as per Ind AS 27, when an entity prepares separate financial statements, it shall account the investments in subsidiaries, joint ventures and associate either at a cost, or they might value as per Ind AS 109. Okay. In the given situation, K Limited valued its investments at cost, that is as per Ind AS 27. No problem in that, they have followed the accounting standards it has to follow. Okay. Ind AS 36 impairment deals with impairment of investments, and in Ind AS 36, an entity shall assess at each reporting period whether there is an indication that asset may be impaired or not. Here, whether there was an indication or not, yes, the net worth had been eroded. Okay, provided 2 subsidiaries of K Limited net worth had been eroded, the chance of recovery is bleak. So these were the indicators of impairment, so they have to do impairment. So the K Limited should provide impairment for the value of investments in 2 subsidiaries, despite the fact the other investments in the subsidiaries did not suffer any impairment. Okay, this is how you have to write. And with regards to the question number 31, We'll discuss that later. We'll discuss that at last. Okay. Now we'll discuss question number 32. That is, AB and company were appointed auditors for N Limited. Okay. For the term of 5 consecutive years. Since it's a firm, it could be appointed for 5 consecutive years, no problem. Okay, as per the provisions of the section, no listed company or company belongs to such class or class of companies may be prescribed shall to reappoint audit firm more than 2 terms of 5 consecutive years. Okay, they're talking about rotation of auditors. Hence, management of N Limited reached out based on the recommendation of audit committee to BCD and Co. Okay, see here. Okay, A company was retiring auditor, BCD is proposed auditor. Okay, for their nomination as appointment of statutory auditor. However, BCD did not provide any written consent for such appointment. Neither they provided a certificate. You see, willingness of law, willingness of company, willingness of auditor, 3 has to be there in order an auditor has to be appointed or reappoint in a company. Here auditor is not at all giving the consent and auditor is not at all giving the certificate that thus his his proposed arrangement was as per act, his limits were as per acts, and the list of proceedings that were pending against him, he's not at all giving this certificate. That is, there's no willingness of the auditor, so this auditor would not be eligible to be appointed if he do not give consent and certificate. Okay, still the management went ahead. No, it should not go ahead. He has to look for another appointment in AGM and BCD. Okay, were appointed. This BCD company were appointed in AGM. You see, even though they did not give written consent and the certificate, they were appointed in AGM. Is that appointment valid? No, it's not valid. Post appointment, TCWG identified that majority of the partners in BCD company, BCD and Co, that is the proposed auditors, the current auditors, are same which were there in AB and Co, the retiring auditors. Could that be so? You see, rotation of auditors, 2 things. First thing, the partners, if it's an LLP or something, they have to not be same partners. Partners should not be in common. Second thing, the network of audit firms also should not be in common. You see, here partners were in common. Now, fearing the contravention of the provisions of the Companies Act, management on guidance with TCWG. Here there were 2 contraventions. First thing, the partners were of the same, of the retiring audit firm and the proposed audit firm, that is the current audit firm, plus the auditor had not given written consent and they have not given the certificate. 2 contraventions we have to discuss. Wait, yeah. They're talking about the provisions and all, and here the appointment of written consent and has to be given. So certificate also should indicate that, and yeah. BCD would not be eligible to be appointed as the auditors. In the above, they all have written the provisions which you have discussed earlier. Okay, and now they have been sinking to the facts of this case. You see, they were not eligible to be appointed as an auditor because, see, the management had not should have obtained the certification and written consent, but they have not obtained, and there were, say, like they have also given the penalties and all, and they have contravened the provisions willfully with an intention to deceive the shareholders and all. So there's also another penalty that would get attracted to that, and these were the things that you have to write, right? The provisions and the penalties and all. Now we'll see our next question, that is, Mr. H. Ramsey was appointed as an engagement partner for conducting audit of K Limited on behalf of his audit firm Ramsey and Associate. Mr. V. Tyagi was appointed as an EQCR for the firm. Okay, there have been implementation of EPR system, ERP system, that is like financial information system, in a phased manner in that company, due to which some of its business process got automated. Okay, business process is internal controls. Okay, As a result of implementation of such system, there was a significant effect on auditors' overall audit strategy. Okay, Mr. H discussed the implementation of that system with EQCR, and also, you see, the auditor will discuss to EQCR only the significant matters, right? Okay, and also told him that such matter may be a key audit matter. Okay, what does key audit matter? As per SA 701, whenever any kind of say like when there were risk was high, it's a key audit matter. When auditors exclusive judgment was there, it's a key audit matter. And any matters that significantly affect a lot of items in the financial statements, then that's also a key audit matter as per SA 701. Okay, and Mr. V considered, EQCR considered the significance of such matter, but however he was of the opinion that such matter did not appear to link with the matters disclosed in the financial statements. Okay, as so he need not, so there was no need to disclose such matter as key audit matter. Okay, he was concluded that this ERP system is not key audit matter and need not disclose. Whether the contention of Mr. V EQCR is proper or not? No, it is not proper, because it's an ERP system where internal controls was also comes under the scope of the auditor, right? It comes under the scope of the auditor, because these internal financial controls actually, the data that was processed under these system would accumulate as books of accounts, and they would come under as output as financial statements. These financial statements were audited by the auditor. So this is a key matter as per auditors judgment or audit work, right? This is actually an important significant matter. Okay, I think they have given the 701 key audit matters definition and all that. And wait, yeah, these aforesaid considerations focus on nature of the matters that were communicated with TCWG, and the fact that the considerations is in relation, the fact that these considerations are required not to be intended to imply that matters related to them as they always key audit matters. Okay, this still they were discussing the 701 things only. In addition to the matters that relate to the specific required considerations, there might be other matters that need to be communicated to the TCWG that required significant auditor attention. See, ERP is an information process system. Like this requires auditors significant auditors attention, right? So this is this drags significant auditors attention. So it's actually a key audit matter or a significant matter to discuss. So they may be determined to be a key audit matter. For example, like a new IT system that was there here in our ERP system was there, right? In the given case, there was implementation of ERP system, same like IT system that was there. According to such matters can be considered as key audit matters if, according to Mr. H, such matters required significant attention of the auditor. Those were key audit matters. So Mr. Vishai is not proper as per matters that this implementation of ERP is not key audit matter. So he was wrong with the contention of that. He just gone with the 701 definition, but have forgot that it's actually an important matter which drags the auditor's significant attention. And we forgot this 31st question, right? Yeah. This is actually you also might could just do that, right? You see, this mostly deals with schedule 3, whether we have already checked one question, right? That is a 4-pointer question. This is a bigger one. I think you might do that soon. Okay, with that said, we have completed our company audit questions discussion also, and hope you have got a great time, and thank you.